manufacturing PMI came out today, stronger than forecast. What do you make of the numbers?
Yes, and they were quite nicely stronger. I think they came in at 51.7 versus consensus of 50.8, so that's quite a decent beat, and it confirms again that I think China is going through a recovery phase. What we've probably seen, if you look at some of the other indicators, electricity consumption, some of the other data which comes out from companies, is that after the initial stimulus effect which came in the second half of last year, that some of that is starting to wear maybe a little bit out. So we've had a little bit of soft patch of data coming through over the last 2 months or so, but this PMI confirms that that recovery, which our economists at least are talking about, is firm, still on track. So I think this latest set of data we had, which looked a bit soft, is really a temporary set of soft data, and then we're going to see better numbers coming through as we go deeper into 2013.
Are there any policy implications? And what is your equity strategy in China?
I think there's a couple of things going on the equity side which are important. The macro side, this PMI data confirms again that it looks pretty good. What I think is even maybe more important is that we're in the middle of the Chinese reporting season, or the Asian reporting season. It finishes by the end of next week. I think about 30 or 40% of all the Chinese companies have reported, so a lot of it still has to come. But so far, a lot of companies are pretty much in line with expectations. And this is the first quarter whereby the expectations of the analysts across the street are meeting the economic realities or the earnings realities of the companies. And I think this is important. We've had this expectation reset over the last 6 to 9 months. Numbers had to be revised downwards. That's not really happening anymore. And I think that sets us up for a Q2 whereby China is going to look increasingly attractive. Valuations have come off, earnings are not being revised downwards anymore, they've actually remained stable, and we might actually, if these P&I numbers inch a little bit higher again, we might see maybe late Q2 earnings upgrades again, and I think that would allow the market to perform better as we go deeper into Q2.
How do you advise clients' position ahead of the possible earnings upgrades that you mentioned, defensive or cyclicals?
We've been somewhat defensive since mid-January actually, in our own strategy and also a kind of portfolio which we're running. I think we still believe that markets are in a holding pattern, but the risk to being defensive is, I think, rising. So as we go over Easter into April and May, we need to reconsider a little bit again how defensive you really want to be. For the moment, I think it's good to remain somewhat defensive and expect that these markets will continue to perform in this kind of holding pattern. I don't see any catalyst for them to really perform strongly anytime soon, unless, of course, some of these results are really going to surprise next week, but I don't think that's going to be the case. I think deeper into Q2, it's really time to think about that position again.
We have the Fed statement and the Cyprus crisis happening outside of Asia. How do you position for such event risks?
Now, I mean, some of the catalysts, of course, inside Asia, the most important thing, I think, is simply earnings revisions. If they're going to be revised upwards, that would be quite key. But I don't, as I said, that's not going to happen anytime soon. But then we have, of course, some of the issues outside of Asia, beyond our control, or beyond the region's control. The Fed has basically said that it will continue its asset purchasing program, and our economists in the US are saying that this will probably continue well into next year. So I think that's going to be on hold, or basically that it will continue. And of course then there is Cyprus as well, which at the moment is a situation which is very difficult to judge from where I sit. It just added a little bit of risk to the Asian market. There is no direct impact on banks or anything like that for the moment. It's really a sentiment issue, and I think if it means, for an example, in Asia that equity valuations are coming off, that actually would create a bit of a buying opportunity.